Harsha Upadhyaya is joining us to talk about markets and investing. Markets are stable. Harsha, but earlier in the day we were discussing within our editorial that this year has started off on a very, kind of a tumultuous note for Indian markets, which braved a lot of stuff last year. Now FII selling is there. So much of, this Adani saga also played its own part in traumatizing the market. But the market stood their ground. I mean, if the all-time high was 18,900 or thereabout, we are at 17,900. So, at least the indices have braved it all nicely. What do you say?
Yes, Ajay, I think that's clearly has happened. What has happened in the last couple of months is one, the domestic flows into mutual funds have moderated, and at the same time, we have also seen foreign inflows going into the markets which were relatively lower on valuations as compared to Indian valuations. And to that extent, we have seen outflows from our market because on a relative basis, India continues to remain expensive compared to many other emerging markets. And that's what has led to volatility in the markets. Plus, this is earnings season and all of that as well, which leads to some bit of volatility. And despite all of that, I would say that, as you rightly mentioned, market has withstood all this volatility. And while we are lower from where we started at the beginning of the year, but this kind of volatility is generally par for course.
Talking of domestic flows, just a while back, we saw the SIP data also come in for the month gone by, and it's already nudging the 14,000 crore mark. How have been the flows to your own AMC, and do you see this strong SIP trend continue? Because if this has held on despite volatility in the market, this surely is a source of strength for the market.
That's clearly a very, very significant trend, and we believe that will continue. Simply because those who have invested into the markets and who have seen the volatility, especially the volatility during the COVID disruption, are unlikely to get bothered by the intermittent volatility that we would see in the market for any reason during the course of their investments. So our belief is the long-term structural money that's coming through SIPs will continue to come. And every month we have been seeing a slightly higher number compared to previous month. I think that trend should continue. However, the lump sum investments are not coming in at this point of time, I would say, for the industry. Also, the redemptions have picked up a bit, which is natural, right? I mean, we are close to new highs in that sense, and there has been some profit booking from investors. So the net inflows into mutual funds have been lower in the last 3-4 months as compared to what the average for the previous 1 year was. However, we believe that the strength in SIPs will continue to give us a reasonable amount of inflows into mutual funds, and that should help weather the volatility as well.
Harsha, what do you make of this point? In the RBI policy document, we saw that governor did mention that they are having elbow room to take further appropriate action if the rates or the core inflation remains sticky. Does it mean that the window for further rate hikes, similar commentary came from US Fed as well. So they've kept ammunition still on for some more, however small they are, but 1 or 2 more rate hikes is possible. If rates remain elevated, how do you think demand in the coming quarters could pan out? Or because cost of capital remains high for borrowings?
Actually, clearly, I think the doors for further rate action continue to be open. However, we believe that given where inflation is, where it is likely to move ahead, and the current repo rate, which is already giving you a positive real rate in our economy, very unlikely that you will see very large interest rate hikes going forward. In fact, our view would be there could be an extended pause in the Indian economy in terms of further interest rate movements. Given that, I think, while there will be some impact for leverage companies in terms of the interest cost, there will be some slowdown in consumer demand, maybe wherever the consumers have taken large loans, etc. However, we believe that that's unlikely to really dent the demand in a big way because if you look at it from the bottom of the interest rate cycle, yes, there has been a significant increase, but from the pre-COVID levels, we have not really gone up much. So to that extent, I think there is unlikely that there will be a big impact in terms of either the demand or in terms of the interest burden on corporates. And anyways, most of the corporates have deleveraged themselves beautifully over the last couple of months.
Right. Harsha, we saw a lot of global flows, come out of India and go to other Asian markets like China, Taiwan, which are relatively much more attractive till few weeks back, I would say, in terms of valuation. Do you think that valuation adjustment has happened now, or there is still scope because we still appear to be pricey relative to our own long-term average or relative to what other emerging markets in the world are trading at?
Jake, generally, Indian market valuations were about 40 to 45% premium to emerging market valuations. And this premium had got enhanced to almost like 100% over the last a few months. And thereafter, we have seen a kind of a pullback in terms of flows that were coming into our country. And most likely, those flows have gone into markets which had underperformed and which were also looking relatively better on valuations. So I would say that tactical change in terms of preference for various countries, depending on valuation, seems to be playing out. Very difficult to say whether it's played out completely or there is some more to go. But I would say that as a country, I think we are reasonably well placed to get a medium to long-term flows. I think our weightage is still one of the highest in the emerging markets. Our market valuations, while they may be higher on a relative basis compared to other countries, but compared to our own historical valuations, it's not very different. And also, there seems to be quite a bit of strength in terms of our earnings progression as well from here on. If you look at the earnings season that's been going on currently, you would notice that there has been improvement in the margins, and at least for the Nifty basket until now, the delivery has been better than expectations. While I concede that for the broader market, the earnings movement has not been so great. It's been lower than expectation, but at least when you look at the headline Nifty earnings and valuations, we seem to be reasonably placed. So I would say that from a medium to long term, India will continue to remain one of the favored destinations for even foreign institutional investors. But what happens over the next few weeks or next few months, given some tactical shift that's already happening in favor of countries which are relatively lower on valuations, it's very difficult to say how those will be.
Fair point. I want to delve a little more on that. Yes, margin improvement has happened, some cushion in the margin has come. But do you see next few quarters, at least 3 to 4 quarters, the earnings growth, because the overall growth will actually be impacted for the country, and hence the growth in earnings may be on the lower side, may actually turn out to be on the lower side, which the street has still not factored it in. Is that possible?
Right now, Street is expecting about 16 to 17% growth for the rest of the financial year as well as for the next financial year. So as long as this kind of an earnings growth trajectory is met, I think markets will hold on. The crucial point here is if commodity inflation continues to moderate and if demand remains reasonably okay, then I think profitability should inch up, which we have seen some signs, at least for the larger companies during this quarter. And maybe some more companies will join that bandwagon next quarter and subsequent quarters. So overall, I think the critical point here is if earnings delivery continues to be more or less in line with market expectations, I think our valuations can sustain these or can build on these valuations. However, if there is any dent to that earnings growth trajectory, then I think it will be difficult for us to sustain the valuations because there is no room for error at this point.
What do you make of, at the same time, while the benchmark indices may have held on, we all know that there is a kind of a silent correction which has happened in the individual portfolios because bulk of them are laden with mid caps. And mid cap, small cap went through a big, nice corrective phase. Do you think 2023 could be a good time to deploy money back in a staggered manner in mid cap, small cap end of the basket? As I'm assuming that, in 16 to 18 months, your sowing can happen and for subsequent harvesting later on.
Yeah, clearly, if you are a long-term investor and if you're not really going to be perturbed by any intermittent volatility, which is likely to be more in case of mid and small cap basket, I think these are reasonably okay times to go and invest. However, if you are looking for a lump sum investment, maybe that's not a right way to approach. Our view on markets is we are more or less around the fair range of valuations. So this is mostly like a buy on dips market. And in case you want to increase your equity allocation, a correction should be used for that equity allocation increase. And also at this point of time, we generally prefer large caps to mid and small caps. But as I said, however, if you are a long-term investor not who is not going to be perturbed by intermittent volatility, or if you're going to invest on a systematic basis, then I think even these valuations, one can go ahead and explore mid and small cap segments.
I just wanted your view on few sectors as well. I mean, Cummins stock shot up today 8-10% on very good commentary. We saw similar commentary from other capital good companies as well. In fact, even L&T, the largest engineering company, says their margins will improve in the second half. What do you make of the opportunity, earnings growth opportunity and valuations which this engineering capital goods space is trading at? Because some call it pricey, some say in early stage it is usually pricey. As we go later, because it's a structural 8-10 year story. How do you analyze this conundrum?
Ajay, if you look at it as a multi-year story, maybe we are at the early to mid cycle in terms of both business outlook as well as valuation. So to that extent, I think there is no worry. However, if you are looking at immediate term, I think one needs to be cautious about the valuations even in this pocket. While if you recall our earlier conversations, we have been positive on the industrial space for quite some time. And the thesis was very simple that given strength in government as well as private spend, we expected the investment cycle to gradually improve. And we are seeing order books of most of these engineering and industrial companies going up. And also we have seen improvement in margins simply because of the operating leverage as well as some correction in the commodity costs. I think that trend should sustain. However, as I said, in the very short term, one should be little cautious about the valuations of some of these companies, I would say. From a medium to long-term perspective, I think one can definitely be overweight on the sector.
Exactly. All right, Harsha, thank you so much for your time. That was Harsha Upadhyaya, of CIO of Kotak AMC, chatting with us on his thoughts on the market. Take a